our team back in the office has been talking a lot about agitation. I think when I meet with people, I think people are more upset than normal. I've been doing this for 29 years, and I just haven't seen this level of concern that people have. And so I try to flip that on its head. And I see something totally different. And I think, first of all, the news cycle, there are a lot of things that they sell the fear trade. And so when you sell the fear trade, it isn't very optimistic by definition. And so kind of tuning that out is very important. But if we flip it on its head, you know, my dad growing up had less benefits than somebody on welfare today. I mean, it's fundamentally different.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Leonard Wright, a thought leader in the financial planning industry. He's an appointed chair of Personal Financial Planning Executive Committee and an appointed member of the Global Financial Planning Standards. Leonard was introduced to me by a family friend, and I think we could learn a lot from his experience. We're going to talk about tax tips, 401ks, and Roth IRAs. Leonard, thank you for coming on the show.
Great to be here.
Yes, sir. Let's start off like we always do. And this is your first time on the show. So go ahead and tell us your story and how you got into investing.
Yeah, it's a fun story, actually. It starts when I was about 5 years old, and I saw what happened in South Bend, Indiana, where my dad grew up. There was Studebaker, and Studebaker failed. And my grandparents' friends were part of that failure. And what that meant was they got about 15% of their pension. Now, back in the mid 60s, if you worked for, factories in America, you turned out pretty rough by the time you're 55 years old. It's a very difficult. My grandfather put asbestos brake pads on housings. And so he had mesothelioma, and it was very hard for him to cross the street. And a lot of his friends, their joints didn't work quite the same because of heavy lifting. And so when you look at that environment, and these people lost 85% of their pensions, that's something that stuck with me until I entered the workforce. So when I entered the workforce in the jewelry industry, it was one of the top 50 companies in America. I was their CFO and COO. First act that I did was put in a 401k plan. Why? Because I did not want to see anything like that happen with any of the employees that I had responsibility for. So I put in a 401k plan. It was roadshowed. The company that came in, nobody signed up because they didn't understand 401ks back in 1988. And some of the questions were, is this even legal? Will the government allow me to take this deduction? Because they're used to not getting any deductions. So for them, it was a foreign concept, even though it's been around for about 7 years. And so, that event back in Studebaker led to the commission that was formed by under Robert F. Kennedy to be mobilized, and eventually, Ford signed into law the Employee Retirement Income Security Act as his first act of president after Richard Nixon resigned. And then the regulations were written in 1981, and we were off and running with 401k plans. So it had only been around for about 7 years. So failure is not an option. That's kind of like the way I believe in life. It's you don't fail. And so I was not about to fail in the implementation. The first thing is the CFO of a company. So I went around to all our different locations. Everybody signed up except for one guy. And this kind of illustrates the impact that just very simple things that you do early on in life happen, because it's amazing how this guy progressed through life just because of a 60-minute conversation with the guy. And so everybody signed up except for this one guy. And then I sat down, talked with him for an hour, and he signed up. And his big issue was he lived in California, houses were expensive, he didn't make that much money, and he can't afford to buy a house. I don't want to save for retirement. And so I showed him how. And I was the CFO and COO of this company for 4 years, given an offer for a healthcare company. Went over there, did the same thing at the healthcare company, came back like 6 years later. The guy grabs me by my shoulder. Now, this guy looked at imperfections in diamonds. We were higher quality than Cartier Tiffany. And so every one of our diamonds went through his fingers. And so he was a very introverted guy, kind of like an actuary, very, very introspective. So he grabs me, pulls me in his office and says, sit down. And when I sat down behind his desk, he starts wagging his finger at me saying, you need to understand you change lives. My life has changed. I have a house. I never thought I could, afford a house. You showed me the way just in a 60-minute meeting. So years later, um, as I'm writing my book on 401k plans, participants, first one, second one is how to do 401k plans or the retirement plan cake properly. Um, I contacted him again. It's been years. And so I called him up and I said, can I use, your quotes in my book and cite your name? And he said, no. Again, he's a very private person. He said, you can use the story, but you can't use my name. So I'm not going to use his name here. And so 6 houses and over $2 million in his 401k plan. And so, could have done things a little bit differently along the way if you would have had advice. Probably so. And I think that's part of what we're going to talk about today, those opportunities that, quite frankly, over most of his life, he didn't have that same opportunity because Roth wasn't around until about 1996. And so there are a lot more opportunities that most people have today that they didn't have back then. But I mean, think about that. A guy that didn't think he could afford a house. And so then all of a sudden I realized, so I'm the CFO of a healthcare company, 31 different clinics across Southern California. And it's like, I'm doing the wrong thing. I got to do something different. And so that was kind of like the genesis of, going into what I've been doing now for 29 years. I mean, it's been a good road and changing people's lives. Rather than changing the companies and impacting people's lives, now I change them one by one, which is really exciting. And at the bottom line is implementing holistic financial planning around this allows people to take advantage of so many different things. So it's been a real privilege. And I think the one thing I would suggest, this is just a golden nugget, because everybody's pathway is different. Everybody works at different companies. And, along this pathway, I became enriched by affiliating with my associations. And so what you see on the screen is an association that I proudly represent. We started the financial literacy movement, 2.5 decades ago. And the people I met in that association were extraordinary. And it was the same thing when I was in the jewelry industry. I belonged to an association. You meet the top people. So as a golden nugget, my pathway has always included associations, involvement, meeting people, networking, and developing important relationships that made my company better, that made my employees better, and in this business, make my clients a lot better because we meet all kinds of different people. It should be interesting as we get into the conversations. That theme is going to roll through because I have amazing stories of people who I just met through the association. So it doesn't make any difference what you do. There's an association related to your business. And getting involved with that will give you upward mobility if you're an employee, which is very important. And it's significant upward mobility. And if your current employer doesn't give you the benefits that you deserve, that you've earned, you always keep your intellectual capital. And you'll always be desired by somebody else because you have that intellectual capital. And if you get maybe a little bit abused by not getting that recognition, both financially and personally and professionally, then your opportunities in other places will only be enhanced. And so that's kind of an important consideration. That's how I ended up where I'm at.
That is an interesting story. The failure of Studebaker led you, I guess that was the spark that led you to where you are today, which being a finance guy, you made sure that everyone was on a 401k plan. That's a pretty cool story. And I get the same kind of joy out of doing this show and helping people. And, nothing makes me more happy than when people are like, I now have the confidence to invest on myself and to plan for retirement. And that's really cool. Okay, so the golden nugget is basically creating a network of people to, I guess, kind of enhance your own intellectual, what'd you call it? Intellectual capital?
Yep, intellectual capital, correct. Yeah. The more you can always, so if you're working for a big company, some large companies, like the oil companies are going through layoffs, all these different companies, they restructure because of what's going on. And you're particularly vulnerable. In fact, my dad was in aerospace. So my dad's a rocket scientist, literally. And so flight pass, Hidden Figures guy, if you ever watched the movie Hidden Figures. So he was that guy. But I just remember growing up in the 70s, they go through these huge layoffs and his entire department would get laid off. But because he was a Hidden Figures guy, he didn't. But just, companies go through those processes. And so you can get laid off, but they can never take away, they can take away your livelihood temporarily, but they can never take away your intellectual capital. And so you owe it to yourself. It's a duty to yourself to get as much intellectual capital about investing, about the things that you do, the relationships that you nurture, and that whole networking when they have these natural economic transitions. If you have a network, you pick up the phone and you're someplace else pretty quickly because there's somebody that knows somebody. And that, to the extent that you dial in that network and always follow up, it creates exciting opportunities that wouldn't exist otherwise. You take care of yourself, and it's always lifting yourself up by the bootstraps and on to the next opportunity.
Yeah, yeah. Very, very interesting. Okay. What macro view here? What is your macro view of the world economy and financial markets as it sits today?
It's really interesting. This is a profound question today. Our team back in the office has been talking a lot about agitation. I think when I meet with people, I think people are more upset than normal. I've been doing this for 29 years, and I just haven't seen this level of concern that people have. And so I try to flip that on its head. And, I see something totally different. And I think, first of all, the news cycle, there are a lot of things that, they sell the fear trade. And so when you sell the fear trade, it isn't very optimistic by definition. And so kind of tuning that out is very important. But if we flip it on its head, my dad growing up had less benefits than somebody on welfare today. I mean, it's fundamentally different. And so he worked in a golf course and he delivered papers literally to buy heads of cabbage for cabbage soup growing up. He was very poor. And our poorest people in America aren't that poor. And so that's a very optimistic way of looking at things. But we don't view life through that lens. But let's just take a look at a few developments that occurred recently and why I'm so optimistic. Artificial intelligence is fundamentally transformative. I was just in San Francisco yesterday, and Waymo's driving around. Tesla's going to be coming up with a similar car like that. And so the technology is at the forefront. But let's just take a look at health for a minute. I gave a presentation last month at the world's largest CPA conference in Las Vegas. And my talk was around risk management, specifically life insurance in the wild is what the topic was. And around longevity. And a lot of times people look at people certain ages like, I don't want to be that 75-year-old guy in a walker that my joints are all messed up and, all those different things. And so what we do is we give kind of, that's how those people at that age are. So therefore, we don't want to get to that age. But the reality is, most people, if you take care of yourself, they're not that way. But our mind is this, it's like a behavioral finance thing. We look at things and then we spread it out more than the reality is. And so what I see is something fundamentally different there. If you're age 65, your life expectancy between husband and wife is about age 92. If you can pass a life insurance exam, or if you have life insurance, because you've been through screening, and that could be screening at age 50 or 45. If you have life insurance and been through that screening, your longevity is longer. And so and what I see around longevity, these are a couple stories that broke the like a few days before the conference. They've done this catheter thing now. It's just new and emerging on the cardiovascular side. The catheter goes in, it has a balloon, saline solution, and a scalpel that gets rid of the plaque. Well, people do the stents. My dad died in 1983. Had there been stents, he would have lived longer. My mom lived to 93. In fact, she just recently passed, but she lived to 93 because she got stents. And so we see that technology. Now there's going to be technology that goes in. It's like, you won't need to have a stent. The day after, there was a great conversation that the owner of the Los Angeles Times had, I don't know, probably about 9 months ago. It's a great YouTube to watch. It's very inspiring. He did an interview with Tucker Carlson, and I don't know, he's like a biophysicist or something. I don't know exactly what he does. I mean, I just watched the video, but he was talking about the transformative side of how they do treatments on different things. His was he sold $1 billion of his assets so he could do research on COVID and have these different nodes. But then he talked about cancer, so you don't have to like do chemotherapy because that's poison and agitates the cell, and so it motivates your immune system. And then recently there's an announcement out of, I think, Australia. I don't know if it was part of his thing, but it was like teasing the HIV thing out of a cell and kicking it out of your body, which is exactly what he was talking about.
Wow.
So if you can eliminate cancers and all this other stuff, or the most of them, and then you got the cardiovascular, what's our life expectancy? I don't know. You can add at least 10 years to that. So now it's 102. So the day after the conference, it was announced out of China that there's a protein that our bodies shut off. And when you're thinking about this contextually, the companies that make it, the companies you can invest in, the money that they're going to make, the money that we can make as investors, this is pretty exciting stuff. And this is just like the very beginning. And so it not manufactured, but it stimulates the protein to be manufactured in your body, which waterfalls. And when you get older, that protein stops to be, it ceases to exist. So your skin like ages, you have all these other different aging factors that kick in. They figured out how to turn that protein back on.
Huh.
And so water falls in. So they started with rats. You may have seen the rat issue. Then they did it with primates. Primates, they de-age skin, hair, heart, liver, you name it. It was de-aged like, about 20 years.
Wow.
And so now they're going to start clinical trials in humans, and they need that in China because everybody's saying China's going to have economic collapse because, two parents, one child. But if they can make their citizens live longer, then maybe they'll be able to have a generational transformation where that's not going to be an issue, right? That's very exciting because then we can live longer, and it isn't just like you live longer and are in pain, and the issues of your cartilage regenerates and your brain regenerates and you think faster and you just feel more vibrant, right? And so what does that do for society and us? And the companies that create this opportunity and the money that can be made off of it. And so and then there are all these other different things with respect to AI and robotics. I mean, isn't this the best time ever to be alive? I mean, if you really think about it, and there's all this negativity telling us this is the worst time to be, alive. And so, the thing in life is, everybody wants a white picket fence. From a psychological perspective, we want mom's home cooking. Every time we go out, it reminds us of mom. It makes us feel good. It makes us feel comfortable. It makes us feel safe. But the reality is, there is no such thing as a white picket fence. The world always has thrown us things. But the way it throws us things today is fundamentally different than it was 100 years ago, or even 40 or 50 years ago. We're fundamentally different. We've been transformed, and now we're going to transform much more quickly. So this is by far and away, if you're an investor, the most exciting time to be alive. And we have to create energy. I mean, all these sectors that are going to be very opportunistic to support all the different transformation that we're about to undergo. So it's incredibly exciting. And there'll be all these jobs and all these opportunities that arise because there always is, right? And if you think about when people say artificial intelligence can take our jobs away, I'm in the accounting profession. And think about what happened in accounting. If you go into any old picture of, a large company in America, what you saw was a warehouse, and they're usually women, like desk after desk, and they did the accounting. Those don't exist at all. Even in my lifetime, when I went to my accounting department, I eliminated like 70% of the positions in my accounting department through computerization. It just means people do different stuff, right? And so, if anything, I would say, and I think the education system probably could reinforce this. Was Mike Rowe, I think. Mike Rowe talks about dirty jobs. There are guys making $120,000 a year doing dirty jobs. And so America needs more of those dirty jobs and acceptance of that, because we need stuff to get done. And, if you're a leader in that area, you can make a lot of money running a business, right? So just so much opportunity all the way around.
Yeah, I've kind of noticed the same thing. I'm pretty optimistic like you, but I have noticed that there's more agitation and kind of more upset than usual. But if you look back in history, when I listen to stories of my grandfather and when he went through the Depression, I mean, his mom died, his dad had to give him up to adoption for a while because he couldn't afford, like the poorest people in America are not that poor when you compare it to the rest of the world. AI is going to be extremely transformative. We can already see that filtering in through the health sector. And you see, although AI is going to replace a lot of those jobs, I was just talking about this with the electricians that replaced my electrical panel the other day. ChatGPT is not going to replace my electrical panel. So, those what are typically considered like blue collar jobs are probably going to be a lot more profitable going forward, something that a computer can't replace.
Yeah, no, I agree. And can you imagine having a robot going around your house doing your laundry and everything? You don't have to worry about that anymore. That'd just be a wonderful thing. So it'll create opportunities that, you don't have people that perform those functions. So it'll enhance the functionality, and our standard of living will rise. Just like it did for my dad when he was a kid to when we lived in Huntington Beach. Yeah.
Yeah. Okay, let's get into your diversification. So I'll share my screen here with the pie chart that you got up. And one, two, three, there it is. Okay, tell us what we're looking at here. What do you walk us through this?
Okay, so when you look at, I always look at investment management, which is the diversification story, the diversification around investment, but there's diversification around a lot of different issues. And so I look at how we do things through the prism of a financial plan. And if you think about the key elements of a financial plan, there's risk management. The most important part of this whole thing is the goal, focus, and execution. You see the image of the head with the heart in it.
Yeah.
That is what is most important to the person. A lot of times people cookie cutter things. And sometimes, if I'm working with an OBGYN or whatever, they say, how many OBGYNs do you have? And you specialize in doctors or OBGYNs. And I just tell them, no, I specialize in the human condition. Because if I talk with an OBGYN and the next one and the next one and the next one, and inevitably people say, well, what do you do with your other clients, or what do you do with, other doctors? It's irrelevant, because it's the person, and every person is fundamentally different in terms of what they want to accomplish. And so I don't like to do any cookie cutting because everybody's different. And having said that, it's kind of the application of the strategies that you put together. So that's the key. I think that's the key driver. And retirement, so we save money so we can get to retirement. Spending, what's the spending plan? By the way, this is interesting. I originally, in accounting, we like to use the word budget. I don't think there's anybody in America that's not a CPA that likes the word budget, because that says you're restricting me. So the reality is it's a spending plan, and you choose and allocate how you spend money, and that's much more appealing. Education planning is going to be like 529. It's estate planning. You get to estate planning. There's an interesting issue around that. Most people think, well, you have to have a lot of money to do an estate plan, and they're bumping it up. I think 15 million per person, 30 million. Then you get into the estate taxes. So they keep on raising it. It used to be 750,000. So we've seen that get bumped up quite a bit. But issues around probate, you don't want to go through probate. It gets messy. And then the state has a set of rules around how money gets distributed if you go through probate. So estate planning is important for everybody. And if you notice, the IRS one, taxes, taxes hit everything. There isn't an issue that you can do in financial planning that taxation doesn't hit it. One of the cool things about going back to education is under some recent legislation, if you have leftover money in a 529 plan over, I think it's a 5-year period, you can blow that out like $7,000 a year into a Roth. And so that's a great planning tool to get Roth money for people who have excess money is to overfund it a little bit and then, roll that into a Roth IRA for your kids. And so if you have 5 kids, you can get a decent amount of money into a Roth for them, and they didn't have to put a penny into it. So there are all these different planning issues that evolve from time to time. Investment planning is where diversification is around, but also risk management planning, right? Because you could have variable life insurance that people buy. And, when we get in discussion a little bit later on, it'll be interesting to kind of see that overlap between investments and risk management because of taxation. And so it's really important to kind of take a look at, some of these different elements in terms of how they filter together. But investment management is the one that most people key in terms of diversification. And sometimes that gets into, fiduciary at FI 360. I'll throw FI 360 out there because if you are an investment steward, manage money in a trust, you'll want to go to fi360.com and get the investment steward's handbook. And the reason why I bring that up, and I don't want to get too much into the weeds here other than mentioning it's an opportunity. The reason why you want to take a peek at that is because at first everything's okay when you're managing somebody's money. And you might hire somebody from some other, wirehouse or firm to manage the money. That's usually what happens. But as a trustee, you have duties and responsibilities, and you have to make sure you fulfill those duties and responsibilities. And so you might not have, you might have like investment expertise in terms of what you've done personally, but it's different when you're responsible for somebody else. And that gives you the fiduciary principles that, you should be following. And so what ends up happening, and I have a fair amount of experience with this when I'm working with clients, is when they're doing that, so the whispering starts from one of the beneficiaries. Maybe a beneficiary starts dating somebody, and then that whisper campaign starts because we could use a little bit more of that money. And then there's conversations around, well, maybe that beneficiary or those beneficiaries, maybe they should get an attorney to make sure everything's being handled properly. And so then if the questions start coming back on the investment fiduciary who's the trustee, then if you don't, dot your I's and cross your T's and know about it, you won't be protected, and they'll start asking questions because their attorneys are very good at asking questions. But if you can answer the questions and fulfill your fiduciary responsibilities, then you'll protect yourself and there won't be issues. And so, again, where there's money and where there's death, there's a lot of emotion, and it doesn't make sense. And so it's really important to protect yourself if you have that capacity. And so I always put things in the framework of a financial plan focused around an individual's goals and a process around that. And the interesting thing I'd say about the goals and figuring out a financial plan, it's important, I think, if you're married or you have a partner or however that works, to get that information from both parties, because different people have different perspectives, and then go back and reconcile what those differences are because you're more effective in what you want to do. And it's really important if you have disabled kids. There aren't very many specialists in the disabled kid and children market. So, and which leads to disabled adults. And there is, now I don't do this. It might be an interesting interview. A colleague of mine specializes in it. I specialize in 4 areas. I'm very, very good in 4 areas. And once I get outside that expertise, I bring in other people that have that expertise. And it would be good to learn it because I have, 2 children with autism, but I have a lot of passion around these 4 areas, and my bandwidth is only so wide. So,
What are those 4 areas?
I do wealth management, risk management, retirement plan cake, and financial planning. Those are areas that absorb all my bandwidth. There's a lot to do in each one of those, and if I expand beyond that, I just don't have time.
Yeah.
So I have colleagues that we do a lot of joint work with, and they say, "Hey, Leonard, there aren't very many people in this area for special needs planning." But special needs planning, depending upon how you set things up, and it's really important to consult with somebody around special needs because if you make the wrong decisions, they're permanent and lifetime. So it's critical, and a lot of people don't want to hire an expert in that area But I will tell you, I've had a lot of information from the person I partner up with that's benefited me personally, because I just don't know all those different elements. And so it's, I think it's really important to get that expertise. It doesn't cost that much money, relatively speaking. And if you make the wrong decision, it really costs you a lot of money over the lifetime of your child.
Yeah,
So, or
I've heard
person you take care of. So that gives you an idea of, why I do the financial planning wheel. And I always bring it up regardless of what I'm talking about. And I think the key element here, when you see taxation impacting everything, taxation does impact everything and how you make decisions, especially around investments and risk management, and how you accumulate retirement dollars. There's so many opportunities that you can leverage, which are very exciting, and we'll get into that a little bit later on. So
Okay. I like how you call budgeting a spending plan, because whenever I kind of go over and help people out and line item everything and I talk budget, I can instantly see them like putting up the defensive walls, you know. But I think if I say spending plan, that'll be a little bit more easier for people to digest. Um, okay, so wealth management, risk management, retirement, and financial planning, that's your wheelhouse, and so that's what you stick to. Let's get into a little bit of, you alluded to it, this one over here, the tax and IRS. What are some general do-it-yourself investor tips that maybe some people aren't aware of that they should be taking advantage of and paying as little taxes as humanly possible?
yeah, it's a really good question. I think when we get into some of the topic around the retirement plan, or we just go there. So maybe bring up the retirement plan cake, and there's a great conversation around that. So
Okay, right here.
yeah,
Okay.
yeah. So uh, what we find is like, I'm sorry. Yes, I'm fine, thank you. I'm fine, thank you. So I'm in a hotel in beautiful Lake Tahoe. So
Oh, that was the
it,
maid ready to clean the room, huh?
it's room service. It's like, no, thank you. Sometimes they ignore the sign on that side of the door. It's like,
Yeah, no,
you
you're good.
really want to make sure you're okay. It's
Yeah.
like, okay, thank you. Well, they do have a requirement now, ever since I guess the Mandalay Bay issue, that they
Oh,
do want to like open the door on rooms to make sure everything's okay. But
okay.
yeah, so I think the retirement plan cake, it is the most underutilized opportunity that's out there in terms of opportunities. So that the opportunities exist for employees, opportunities exist for employers. So I can speak contextually on both sides. And there are, if you make under the non-highly compensated limit, some 401k plans have um, a non-deductible contribution as well. And so, what's interesting is depending upon facts and circumstances. So a lot of people inherit money, and the question is, when you inherit money, do you want to have it taxable or non-taxable? So um, this is really for everybody and opportunities. Now, everybody might not be able to take advantage of it right now, but I was talking with somebody who was forming a new relationship with, and that's exactly what happened. So what I'm going to do is I'm going to go through and explain it, and I'm going to throw some cases in here, which are really pretty cool cases. And then when you make more money, some really cool opportunities to be able to save more if you're an employee or if you're an employer. And so we'll look at contextually at both of those, which are very exciting. So the three layers of the retirement plan cake. The first layer is 401k. And 401k is a salary deferral program. There's a little wrinkle in it for the non-deductible opportunistically, but generally speaking, it's all salary deferral. So that's what we're all familiar with. To give you a little bit of a landscape there in terms of companies that have a 401k plan, there's roughly 725,000 companies that have a 401k plan out of 6.1 million companies with business owners. So kind of how it shakes out, somewhere between 12 to 14% of America's businesses have a 401k plan. So about 50% of Americans are covered by them. Why? Because the big companies that employ tens of thousands or hundreds of thousands of employees have them. And so about roughly half of Americans are involved with 401k plans, and the other half are not. There are also SEPs, simples, and there's some harmonization with the 401k rules regarding the type of account that you can set up there. And so it's about 18% of all businesses in America have some form of retirement plan. That retirement plan can also just be a profit sharing only. It could be a cash balance plan, which is a hybrid defined benefit plan. There's some rules. I'll share some of the rules for the business owners out there. But if you're highly compensated, it's also good for employees. There are a lot of employees that maybe are involved with sales, or they might be high tech people that are in between 250 to 500. If you can get involved with, or they might be professionals, lawyers, architects, whatever. But there's an opportunity for you to be able to save a little bit more in cash balance plans, if that's something that you so choose, or at least that you would advocate for. It's always the decision of the business owner in terms of the construct of your retirement plan cake. But I think this is kind of visualizes it really good. And so at the 401k level, there's salary deferral, and the salary deferral, you can either deduct it, which is the traditional. It's been around for since 1981, and then in the 90s they had it so you could do a Roth. So there's a Roth option, and for a while a lot of plans didn't have Roths, and more and more companies have been adopting. I believe about 85% of 401k plans now have a Roth designated account. What's not so common is a non-deductible. And so the non-deductible is, a lot of tech companies have the non-deductible. It's the second bite at the apple. So if you're looking at a Roth designated account, which you don't get a tax deduction for, and a deductible one, you're limited to that, like 23,000. Actually, this is an older image, but it's 31,000 between the catch-up contribution and the deferral. So if you're under 50, it's going to be like the 23.5, and the catch-up is going to be the $7,500. So that gets you to 31,000. So you can allocate between the non-deductible, the Roth designated account and the deductible, 31,000, whatever you want to do. Second bite of the apple is non-deductible. So what a lot of companies do is, in order for the highly compensated people to be able to save without being tested in the plan, because if it's not a safe harbor plan, they adopt a safe harbor plan. If it's not a safe harbor plan, you go through the testing, and then the highly compensated, 160,000 and above, index for inflation. The highly compensated then are subject to testing, which is essentially 2% above the average that people save in the company. So if people save an average, you have all these people that don't save, that's 0%. And then if other people save and an average is 2%, you can save 4. And if you make 200 and you put in 23,000, well, you can only put in 4 of the 200, which is 8, then you have to get a check back. And so that's the reason why some companies do a safe harbor. And so when you do the safe harbor, there's none of that testing. So everybody gets to save. There is no exception for the non-deductible contribution. That's where you get these mega backdoor Roths. And so for people who want to save money in a Roth, putting money into a Roth is a good idea. And usually when I'm working with multi-generational and there's gifting with my clients, I usually, because the children won't make as much money, but I usually recommend to the parents that they gift it, and they request that gift goes and have their child go, put the money into a Roth. And so what you do is you just increase what you have in terms of the money coming out, because it is a salary deferral, but that's made up with the gift that the parent gives them, right? So it's going from one shell to another, but you're basically Rothifying that money and having them save it. And so the gift amounts can be fairly, decent, right? It's 16,000 per child per person. So if you have mom and dad, you can get like 32,000. And it is actually more than that, because you have to file a gift tax return over that. And since it's like, the amount that you can give them is so much money, it's probably worthwhile to consider, filing a gift tax return from time to time as well. That gets into that tax part that we're talking about. How are you transformative in terms of transforming tax dollars into tax-free dollars for the rest of your life? That's Roth. And so that's pretty cool. And we'll come back to that in just a minute and some strategies. The second layer, so one of the areas, and you kind of see there's safe harbor match, dollar for dollar, up to 3%, 50% on the next two. If the participant saves 2%, then you match 2% dollar for dollar. If the participant matches 5, the employer gives you 4. So that's safe harbor and the match. There are some derivatives of that. They're rare, but sometimes they give more. So that motivates people to save, and that's why a lot of employers say, "Well, if I give you this, that'll motivate the employee to save." That's not accurate. What motivates people to save is automatic enrollment, and
Uh,
the state IRA programs. I worked with the state of California on the synthesis of the state IRA programs. This will kind of blow you away in terms of what that difference is. A lot of people think that a state IRA program, people won't want to do it because it's a state. And a lot of people in my chair have some level of discomfort with it because it's intrusion in the marketplace, right? It's a government getting involved. California set it up. They set it up with the Roth, which was great. And then they set it up as automatic enrollment. 65% participate. 65% participate. And I will say that the vast majority of those are on track for retirement because the average savings rate is like 5.2%. That is, the state of California is a model for the rest of America, both in the private and the public sector. It is a model that automatic enrollment works. And when it's set at 5%, you get on track for retirement at 5.2%. The interesting thing on that is there's a federal match that's coming pretty soon. And so that's very interesting if you're at a certain income level. But so, back to the private sector, that doesn't necessarily drive involvement. It is automatic enrollment, and that is a very important key feature. So profit sharing plans are very interesting. So we'll speak from a business owner perspective and employee perspective. So sometimes business owners will give you a profit sharing contribution. Sometimes only a profit sharing plan. And so there are different ways to set up a profit sharing plan. Most of them do the average one, the typical one, which is you set up a profit sharing plan and basically you have to give, there's just like age weighted, so you can do things based on age. So maybe you can give a little bit more to some than the other, but it isn't a lot more. The profit sharing programs that I like to have set up it's called new comparability. So if you're an employer, you want to write the word new comparability because most plans are not new comparability plans. And why do you want that? Because new comparability allows you to stratify your employee base. What does that mean? That means if two people do different jobs, that give different contributions to the bottom line, and they're not highly compensated, they make under 160,000 a year. I have the ability to be able to reward those employees at a different level than other employees. And so, supposing I have a computer programmer and I pay him $130,000 a year, and that guy's been knocking the cover off the ball for me. I'm kind of like new in business, I'm growing it, but like 7 years later, it's like, okay, we're kind of like knocking it out of the park a little bit. And I go, I'm looking at this guy that was a programmer that fundamentally transformed my business. And now it's year 7, 8, or 9 or whatever that he's been there. And now I want to give him like $100,000. I can write him a bonus check. That's an option. But what's going to come out of it? If you're in California, it's 50% in tax. And so between the state of California, Social Security taxes, right, and all that stuff, and basically you get into Medicare because it's a larger amount. But it's great big sucking sound from a tax perspective at the highest tax rate that person's in. And so when you look at it from that context, there might be a better way. So you can actually have money going into a profit sharing plan because he's in a different strata and he did something for you. And you can put, I don't know, 20,000, 30,000 bucks for a period of years into that profit sharing plan and not have to contribute proportionally to other people. So it allows you to be able to begin to marry the plan to your corporate culture. Now, on the flip side, supposing you're an employee, if the plan has new comparability, and you've been doing things and you're getting a bonus and you don't need the bonus, you can go to your employer and say, hey, you know what? Is our plan a new comparability plan? And your employer is going to say, what's a new comparability plan? And you're going to tell them, and it's like, I'd like to have that set up because, you know, um, you know, I would like to be able to maybe not have that bonus of 30 or 40,000 bucks taxed at these higher rates. And so that gives you an opportunity to be able to put that in. And maybe you are in a Social Security taxable area. So what's an advantage for the employer? The employer is, if you're Social Security taxable and you're making like 120 and you can get $30,000 bonus, that $30,000 bonus can be subject to Social Security, Medicare taxes for you and for the employer. So that's like 15%. So your employer gets rewarded, you get rewarded, you permanently eliminate that Social Security tax, and then it goes in, into that plan. And so there's a lot of opportunities there. And so that's one planning area. And there are a lot. I mean, the way I look at this is, if you spend a little bit of time, you can marry this to the culture of the company. Every company has a little bit different culture. What are the cultural distinctions your company has to drive your business, and how can you reward those people that create the outcomes? Because life is about outcomes, and you can actually create plans that create better outcomes in your business, reduce turnover. And one of the clients I was working with was talking about in his business. It costs more money. I mean, because you have to put money in order to be able to do certain things. But he said, I would love to spend that amount of money, because if I could eliminate turnover, then I'd spend, 15 to 30,000 less, because every time I get a person in the first year, they break something that's cost me 15 to $30,000 more in his equipment that he uses in his business. So if I can eliminate my turnover and give people more money so they don't leave, that's really a good thing. So getting into the cash balance plan, do you have any questions at all? I mean, I'm just kind of like rambling on here a little bit. I just want
Yeah,
to
let's do the cash balance, and then we'll get to Patrick's listener question.
okay. And I may want to get a little bit to around diversification, because there's a good diversification question in this. So, but anyhow, let's see, what's our time? I want to check in on our time.
I've got about 10 minutes.
10 minutes? Okay. So we'll get into this, and then there'll be some like key points around diversification, and then the other one. So the cash balance plan is it allows you to be able to take deductions if you're a business owner up to $300,000. And that is a big deal. Now, there are a lot of facts and circumstances around it. Thing I'd have to say is, this is teamwork. You can see the flower down there to the lower right hand. You got like 4 petals on it.
Yeah.
The golden flower. So that represents the different players in the game. So you've got a plan provider, which could be Transamerica, it could be Principal, it could be Voya, we Empower. I mean, there are a lot of players in that marketplace. And then another pedal is, I always believe you work with your CPA in making these determinations. So I tell everybody, work with the CPA. A lot of people don't want to, but it's a really good idea, because if you do this right, it's good to build relationships with CPAs, because they have business owner clients. And what business owner client doesn't want to get a tax deduction when they're making a lot of money and they're paying a lot of taxes, a lot more taxes than they'd like to. The other is the third-party administrator. And this is a key player in this game. A third-party administrator can be bundled in with the plan provider. Sometimes they're bundled in. But when you get in the cash balance plan space, usually they're not bundled. And so you have to work with a third-party administrator. Think of a third-party administrator as the CPA for retirement plans. They file a tax return every year for the retirement plan, which is called Form 5500. And they will model solutions. So, I can just kind of throw out, under the right circumstances, you can get these big tax deductions, sometimes 600,000 between husband and wife if you're working in the business. Those are very, very big tax deductions, but they model it and see what applies to you based on the employees. Pretty complicated, but they simplify it somewhat. And so by working with people who know about retirement plans, that's my role. That's the fourth pedal, is to kind of be the interpreter between the third-party administrator, the CPA, the plan provider. So we put it all together and simplify it. That's the purpose of this image. So how does it all work together? So this is unique in America. This image doesn't exist anywhere outside of my office. So I created this because I wanted a simplification. And so in order to get to the cash balance plan, what you need about 4 to 7% going into the profit sharing, and then you contribute a little bit of money to your employees. And what that simply means is that, if you have a safe harbor plan and you didn't have it in the matching, you had it in the profit sharing side, and you were giving, maybe an average of 3% because you had decent enrollment. That 3% on the profit sharing side already counts toward the cash balance. And then you're giving, 1 to 4% more. And I think there are a couple big objections from the employer side. One of them is, I don't want to give more money to employees I don't like. That's a valid concern, because it frustrates people when they have people that are going to be transitioning out. And what I would say on the employer side is, it's easy to do a construct and a plan that they're not going to be there that long. You're not going to pay them, or you're going to pay them a small amount. That's a conversation for a different day. The other is, I worked very hard. It was hard for me to get there, and I don't want to spend the money. And so we know that about 82% of employers don't have a plan. The adoption for these plans are very lucrative. There are huge tax credits. In fact, Secure Act 2.0 said for the first 2 years, it's $1,000 tax credit for contributions you make to employees. So you get $1,000 tax credit on that. Year 3 is $750, year 4, $500, and then year 5 is $250. It's tax deduction. So if you're in a high tax state, it's you're going to reduce that amount, because when you file your tax return, you're going to report that, and it's 50% less. There are regulatory provisions, and some of the regulatory provisions are that you claw back money based on longevity. So there's cliff vesting, and there's vesting over 0, 20, 40, 60, 80, 100%. So it's like over a 6-year period of time. So there's time vesting. Cash balance plan is subject to a 3-year cliff vesting. It can be vested right away. Some people want to do that, but most people do a 3-year cliff vesting. So if they're not there eligible for 3 years, you claw back the money in a forfeiture. So that reduces your expenses. So you kind of see the expenses get reduced by 75%. The expense thing isn't an issue. And then there are many other opportunities beyond that. The qualified business income deduction, really important if you make, if you're a professional, or if you're running a professional consultancy practice, or you're a sole practitioner or something, and you're like 600,000, you can reduce that below the qualified business income deduction and get that 20% phantom deduction. And so that'll give you probably somewhere around 20 grand of permanently eliminated federal income taxes. So if you have a few employees and your net after that whole story is about $7,000 out of pocket, so you can get a $300,000 deduction, then you get the QBI, then it doesn't really cost that much, right? But again, facts and circumstances vary. You have to run it. I can't overemphasize the driver in that discussion is the third-party administrator to see how the facts and circumstances, apply. And so finally, I'll just use one example. Somebody inherits some money. They have $1 million. Where are you going to want to put that money? You're going to want to put that money in the 401k side. And if you can, and you could be making $50,000 a year or $75,000 a year. You inherit that money. I mean, there's a proclivity to spend, but to the extent that you can carve out, parts of that, because that's non-taxable. Inherited money, there's no taxes on the transferring of that, unless it's over, the state tax threshold, and there's state planning issues that you can get into. But really, at the end of the day, very exciting, because when you get that, what you make off of it's going to be taxable, but you have the ability, because you're not highly compensated, if your plan has a non-deductible contribution, take that second bite at the apple for both you and your spouse. So it could be 62,000 going into Roth every year. That's $1/8 of $1 million, and that never gets taxed. To be sure, from an estate planning perspective, when you inherit that separate money, that's a discussion from an estate planning perspective. You have to get clarity around in terms of, when you transfer that to your spouse's money, if your spouse is putting it into a Roth, you're giving up 50% of that money because it's in per Roth, and it's a marital asset. It transfers from being a separate asset to being a marital asset. So you can kind of see contextually that financial planning wheel, how that kicks in every step of the way, right? So what I would say, it's very important that none of our conversation here has been recommendation. The only recommendation is financial planning, and financial planning reveals the proper context and what's in the best interest of the individual. So, and then I guess real quickly, we can get into the diversification side and cover that. Because diversification applies in 401k plans, et cetera. And so, do you have any questions around this before we segue, or did you want to maybe ask a question around diversification, your thoughts around diversification, and we can go from there? Or?
Well, I want to make sure we get Patrick's question in here, and then we have to wrap up. I think we're going to have you on for a second,
Okay, so
a
we're done
second
with that
time,
then.
Leonard. Patrick's got a question about traditional IRAs and Roth IRAs, and he says, trying to figure out if I should convert my traditional IRA to a Roth IRA. Trying to figure out the cost, if I should do it based on my age, dollar amounts, etc. Is there some magic formula that you have that's worth doing the conversion? Thank you for your work.
Yeah, so what I would say is I mean, you can't really respond to like magic formulas and stuff because everybody has different sets of facts and circumstances. We just were talking about somebody inherited some money and how to like, sandbag the Roth and using the non-deductible, because non-deductible converts over to a Roth. So depending upon his personal facts and circumstances, what I would say is when there's variability in income, it's a great opportunity to be able to convert because you use up lower tax brackets. If you're consistently in a certain tax bracket and you have this money and you want to use that up and potentially you'll be in a higher tax bracket in the future, you want to give consideration to you using up that tax bracket. So, there are a variety of different facts and circumstances that arise that trigger, the potential for doing that Roth conversion. And what we have to remember is the characteristics of Roth versus the regular IRAs. So, from an estate planning perspective, so there are no required minimum distributions. So as you do the financial plan, one of the things I look at is micro Roth conversions. And a lot of people retire, pre-RMD, which if you were born in 1960 or after, you're age 75 is your RMD age. And so if you were born after 1960, which most of us are, that gives you an opportunity. If you retire before age 75, usually there's lower income because you're not getting the income from your employer. And so that gives you an opportunity to be able to do micro conversions and model what that looks like to absorb those tax brackets. And when you get to age 75 and have the RMDs, I think the biggest frustration for most people who have done a good job, had the good habits, had proper spending plans, and accumulated a good amount of money to live comfortably is when they don't need the money out of their tax-deductible IRAs, that they distribute in excess of what they need, and that excess is taxed an amount that they just don't want to pay. And so also from an estate planning perspective, if you think about money in a Roth, then from an estate planning perspective, that gives rise to, like when the kids inherit it, there's an RMD requirement. And when I'm looking at IRAs, usually kids get it in their highest income years from an inheritance perspective. So you got to distribute that within 10 years. You got to be distributing not the RMD amount if it's an IRA, otherwise you're going to get whacked at the end. So if you
You mean
inherit
required minimum distribution, so that they're required to take a certain amount each year, right?
correct, yeah.
Yeah.
And so they postpone that under the regulations, but they're starting they're because the regulations came out right around COVID, and they kind of postponed the requirement that you take those RMDs, but now they're going to start to enforce that required minimum distribution requirement, even if you're a younger age. And so, if you have that $1 million amount in a just a deductible IRA, you've got to be thinking about taking 15% a year because you're going to make income off of it, and you don't want to have that big lump sum coming out at the end. Whereas a Roth, you can take that, the kids can take that required minimum distribution, and then the lump sum, who cares? It's free. It's tax-free. And so you can defer the longest period of time for the kids. Is that right? I don't know. You might need it for your life and might not be giving it to your kids. I mean, when we get to the diversification conversation next time, and maybe a little bit, more examples around, how these work, because you'll probably get some questions. It might be a good Q&A, the next time around for us to take a look at the retirement plan cake and some of these other opportunities and options. So what I would like to mention around IRAs and inheritance, because I think this is important. A lot of people don't know about it. If you're a spouse, if you're unfortunate to have your husband die young, like my dad did at age 53, the arm, you can have a spousal IRA, but you lock it up. So you have to wait to age 59 and a half, otherwise you get penalties. Spouses can elect, if they need the money, to do an inherited IRA, and that way you can access the money through RMDs or whatever. And so you can have an income stream that comes out before. Now there are some other wrinkles like 72T that people can do, and that is for another show. And so that's a curiosity. Somebody might want to Google it to take a look at it, but there are like these ways to get income that should be interesting fodder for conversation the next time around. This has been a lot of fun.
Yeah. Leonard, I can tell we only scratched the surface of everything you have to offer. If viewers want to get a hold of you and follow your work, how can they do so?
Yeah, so my email address is wrightplanners@hotmail.com, WRIGHT planners, PLANNERS @hotmail.com. If you Google me and key in rethinking65.com, rethinking65.com, there are a number of articles that explain, the retirement plan cake much better. There are 4 articles I wrote for that publication. And so you can put Leonard Wright, rethinking65.com. The ICPA has a number of different resources, AICPA.com and CalCPA, the same thing. There are a lot of consumer resources. You can kind of go around those different websites. And, it's just, it's a lot of fun, this business. And it's a privilege to spend some time. I've really enjoyed talking with you before the show. And this was just an exceptional time. So I thank you for allowing me to entertain your audience for a few moments. It was a privilege.
Pleasure's all on this side of the table. Leonard, thank you for coming on the show.
Thank you so much.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.